Japan debt shock, global contagion and immediate positioning. Japan's recent fiscal shock has triggered a violent repricing in sovereign yields and is already transmitting to global markets. A promise of unfunded tax cuts and higher spending pushed long-dated Japanese yields sharply higher in one session, breaking a decades-long pattern of ultra-low volatility. That move exposed the fragility of an economy carrying extremely high public debt and dependent on suppressed yields to service that debt. How the sequence unfolds: there are 4 repeating stages when a major debtor loses bond market confidence: setup, dependency, break, contagion. The setup is decades of growing debt that becomes unsustainable at higher rates. Dependency arises when central bank interventions and domestic holdings keep yields artificially low. The break is a sudden confidence shift that forces rapid repricing of bonds. Contagion spreads through global linkages: foreign holders repatriate capital, risk-free rates rise, and assets priced off those rates, stocks, real estate, corporate credit, revalue downward quickly. Why Japan matters globally: Japan holds massive foreign assets, including a large stake in U.S. Treasuries. Higher domestic yields make domestic paper more attractive, prompting sales of foreign bonds. On a multi-trillion-dollar treasury market, even small yield moves imply huge mark-to-market losses and force repricing across equities, credit, and real estate worldwide. Rising yields increase discount rates and borrowing costs everywhere. Leveraged sectors and long-duration assets are most vulnerable. Immediate market mechanics and risks. Bond yields: sudden large moves in long maturities can trigger margin calls, forced selling, and a feedback loop that amplifies yield spikes. Equities: higher discount rates depress valuations. Elevated price-earnings multiples imply significant downside if rates normalize higher. Credit: corporate spreads widen as risk-free rates rise. Refinancing stress increases for highly indebted firms. Real estate and mortgages: higher long rates push mortgage costs up, freezing transactions and reducing property values. Currencies: sharp yen moves force repatriation and further selling of foreign assets, deepening global stress. Historical parallels: similar sequences played out in prior sovereign debt crises where fiscal policy broke market calm and produced cascading financial stress across regions. Each episode shows that once bond market confidence fractures, interventions must be decisive and coordinated to halt contagion, and even then the path is costly. Practical positioning: immediate actions. Reduce long-duration bond exposure, maturities beyond 5 years. Duration amplifies losses when yields spike. Shift to very short-duration cash equivalents, T-bills, money market funds, that reprice quickly and preserve liquidity. Trim equity exposure: consider reducing 30 to 40% at elevated valuations, especially in high-duration, richly priced sectors. Rebuy after repricing. De-risk emerging market and highly leveraged international exposures. Currencies and local debt are vulnerable to abrupt outflows. Reassess real estate and right allocations. Higher rates compress values and increase debt service costs. Hold a liquidity reserve, short treasuries or cash, to buy quality assets at depressed prices if distress accelerates. Consider non-correlated hedges, allocated precious metals, as portfolio insurance against extreme dislocations and currency stress. What to watch now: leading indicators. Auction demand and follow-through moves in long-dated Japanese bonds. Flows out of foreign bond holdings, especially U.S. Treasuries held by major foreign investors. Global sovereign yields, U.S., Germany, U.K., and cross-market spillovers. Credit spread widening and margin call events at large pension or leveraged funds. Rapid yen moves and central bank communications or coordinated interventions. Possible outcomes and timelines: if policy responses fail to restore confidence, expect a rapid global adjustment over weeks to months, equity corrections, widening credit spreads, and slower real activity. A coordinated central bank intervention could stabilize markets but at the cost of large liquidity injections and potential inflationary side effects. If intervention is insufficient, the adjustment could broaden into a deeper systemic episode requiring unprecedented policy measures. Bottom line: this shock is not merely a regional bond event, It is the trigger of a global repricing mechanism. Given integration and leverage across markets, the safest short-term posture is liquidity, shorter durations, and a readiness to redeploy capital after valuations reset. Decisions made now, before further repricing and potential contagion accelerate, will materially affect outcomes for portfolios and retirement accounts.